Listen, you came on set just a minute ago with an interesting story. You've seen Celerity do this in the past.
Oh, yeah. So Ryan Terpstra, who runs Celerity, a bunch of years ago, we actually got the Celerity feed when I was working at a hedge fund. And I was actually the first person to see Microsoft release their earnings because Celerity has these algos that go out and search for the IR page. And I'm sitting there and looking at it, and I'm like, could this possibly be true? And 5 minutes, 7 minutes goes by, and Microsoft's not moving. And then I tweeted out, and all of a sudden, Microsoft starts to move. It took that long for the market to integrate it. This time, it was kind of immediate that it went down 3%.
Oh, how far we've come.
But yeah, so we get 3% this time, but the stock's down 20%. So there was a 17% arbitrage there if you really knew that the numbers were real. So for anybody who had the Celerity stuff, and I have no interest in Ryan's company, but it's pretty interesting that they've got these algos.
Well, how much, Paul, how much of that 17% differential do you think is investor disappointment in the actual earnings release, and how much of it is investor disappointment in Twitter's IR department?
I think it's really all about the fundamentals here. I think what the concern for...
So it's not a loss of confidence because people are like, you know what, these kids don't even know what they're doing.
No, and initially, this is a top-line story. This is an active user story, and it's still a revenue story. And investors are very concerned that they're trying to figure out, is this a niche medium on the web, or is it a mass medium like a Facebook with 1.4 billion users? And that's the big rub here. So when they come up with a revenue miss, that really goes to the heart of the matter, which is, geez, I'm not sure these guys can grow their sub base, and even if they do grow their sub base, I'm not sure they can monetize it. And that's what we're seeing here with these really weak second quarter guidance, weak full year revenue guidance. It goes to the revenue story, it goes to the monetization story, and it just brings to the surface once again, kind of the concerns from Twitter from day one.
Well, let me go in that case back to Aaron Kessler from Raymond James, who really summed it up perfectly before we saw Twitter begin to trade again. And Aaron, you had the right directional call as well. I mean, you sort of knew this had to come down further after the shares resumed trading. What do you think about the kind of drops we're seeing now? I mean, 20, 25%. Is it worth a quarter of Twitter's value?
Yeah, not a big surprise. I mean, the stock was at kind of the $40 range, even sub-40 before last quarter when they put up pretty solid results. But even last quarter, the results were a little mixed. They had relatively strong top-line results, but the user growth was somewhat soft. This quarter, user growth improved somewhat, but now your advertising results are mixed here. And that's been a concern. You have weaker sub-growth, and now you kind of have mixed ad results as well. So that formula doesn't translate into good success for the stock near term here.
Why can't they monetize things well enough? Why can't they acquiesce to investors' demands to turn more tweets into ads?
Well, the issue here is that they rolled out these new ad products, and they just didn't get the uptake they thought they were going to. And Twitter's whole stock is based on their ability to generate revenue growth at a very high clip, given their multiple that they trade at. It's funny, the MAU story has kind of receded into the background over the last couple of quarters because of the fact that they've proven they can do the revenue growth, but this really throws that all into question.